morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're talking all things fixed income, and that is for the conservative investor, both in the domestic or Trinidad and Tobago dollar market, as well as the US dollar investment landscape for bonds and other fixed income type instruments. Now, it has been pretty tough going for investors in the bond space over the past couple of years, but could things be about to change with recent changes in sentiment by the U.S. interest rate policymakers? Well, let's take a look, as well as how things might be stacking up in the domestic landscape for the fixed income investor. Turning quickly to our local or domestic landscape, we can see that government of Trinidad and Tobago yields, or as measured by the yield curve, have been relatively stable over the past year or so, with very minuscule changes over most of the major benchmark tenors. Indeed, the 5-year would have been up just around 7 odd basis points, or 0.07%. The 10-year up just around 30 odd basis points again, or 0.3%, and the 10-year, and the 30-year up down just around 4 basis points over the comparable period of 2020, or the December 2020 yield curve versus 2021. The major change would have been, in fact, a very significant drop in that 2-year government treasury yield curve point, from falling from 2.56 in December 2020 to just around 0.92%. So certainly a little bit of pain, or a much less attractive proposition for fixed income investors in the very short government of Trinidad and Tobago bond space or note space. And that is being driven really by a couple of factors, but one of the main trends to look forward to in the coming months would be local inflation, and that has in fact been trending higher after being near zero in March of 2020. It has continuously ticked up, and certainly with the supply chain shortages, which have been making headlines over the past couple of months, we have seen headline inflation increase to 3.9%, and that is being driven really by a very sharp increase in food inflation, which registered at 7.6% in October of 2021. And that does not yet factor in major price changes in the prices of, for example, flour, milk, some meats, and select alcoholic beverages, to name a few. So certainly on the inflation, from an inflation standpoint, that would be something to watch. When we take a look at the local market outlook for the domestic bond market, we can see that in the next coming months, high inflation will be more likely on the cards. Again, with much of our inflation being imported, we can see that excess liquidity will also play some role in determining interest rates, and excess liquidity, or excess commercial bank liquidity, has averaged just around $8 billion over the past year, which is significantly higher than the 2017 to 2019 levels of between 3 and 4 billion. So certainly that will keep some downward pressure on interest rates. Increased bond issuances, particularly by the government of Trinidad and Tobago, as they seek to finance that estimated $9.1 billion budgetary deficit for fiscal 2022. And overall, with the dominant factor, in our view, influencing interest rates set to be the stimulation of domestic economic activity, we expect interest rates to be on the lower end. Turning quickly to that international side, where there has been much more of a pronounced upward increase in interest rates over the past year. When we take a look across most tenors, from the 2, 5, and 10-year government U.S. Treasury yields, of course, there has been increases of between 0.6% and 0.9% over these benchmark tenors at the 30-year mark. Less pronounced, but still upward when we take a look at a 2021 yield curve in green versus the orange yield curve of 2020, just a 25 basis point or 0.25% increase there. Now, that is really a forward-looking sentiment of expected increased interest rates. And it's not going to be too much of a surprise. It has been well telegraphed by the U.S. Federal Reserve, the policymaker, in terms of interest rates in the U.S. And we expect 3 to 4 interest rate hikes over the course of 2022, certainly as based on very, very, very well communicated guidelines by the U.S. Federal Reserve. Inflation continues to persist. In fact, inflation at the December 2021 level hit a nearly 40-year high in the U.S. of around 7%. So certainly some worrying trends there. And of course, with imported inflation, that could have significant impacts on Trinidad and Tobago prices. Expect with those two factors, increased market volatility in the bond space, and certainly as the cost of raising debt increases for many issuers. There could be credit rating actions in the months ahead. So perhaps more dynamic interest rate environment for the international or US dollar bond investor going forward. That has already started to impact Trinidad and Tobago US dollar bond prices, as we can see if we focus on that lovely lavender color, that most of Trinidad and Tobago's US dollar bonds are currently trading at the lower end of their 52-week trading range, with the exception of TSTT, which is actually trading somewhere in the middle to higher end of that trading range over the past 52 weeks. Now, what does all this mean for investors? Well, with the prospect of higher inflation, the first thing is you should be invested to fight and to at least partially fight the effects of inflation on eroding your purchasing power. So holding cash right now is certainly a no-no for most investors. If you do have a significant part of your wealth held in cash at the bank or anywhere else earning little to nothing, consider income funds instead. If you have a shorter term outlook where you'd at least earn some degree of return, repurchase agreements are also a very good short-term approach to investing your funds with much lower risk. Consider floating rate bonds in the case of the US, where they are much more widely available, much less available in the Trinidad and Tobago dollar space. Looking at fixed rate bonds, if you must invest, focus on credit quality. If you are looking at a fixed rate for a period of time, given that interest rates are likely to increase, particularly in the US, which means that your principal could go down in value at least for a short period of time. And also you can consider term deposits at traditional commercial banks, which admittedly are a little bit less competitive in terms of rates to similar tenor instruments such as repurchase agreements. So lots of things to consider for the fixed income investor. And certainly you can give us a call at 226-8773 or 2BOSS for more information. Email us at invest@boursefinancial.com, or of course check out our website at bourseinvestment.com for this and all of our other absolutely free research. And you can catch us in today's business section of The Guardian, on page 17 or thereabouts of the bigger, better Trinidad and Tobago Guardian. That's it for this week's edition. Stay safe, get vaccinated, and see you next week on the Bourse Report.